Stock charts trading with the MACD divergence. When using the MACD indicator and it produces a high, and then the indicator produces a lower high, while price creates a high, then making a higher high, this is a bearish divergence. For the opposite effect, when the MACD histogram is making higher lows, but the price chart is making lower lows, this is a bullish divergence. Anticipation that momentum will go upward or downward when you see these divergences take place. For me, the biggest takeaway of this pattern setup is that you have to have two peaks, one going higher than the other, or more than two valleys going lower. And this is the reason why that's such a big takeaway, is because of reversal patterns. In reversal patterns, you'll see two peaks, and again, showing you bearish reversals. From there, price should go lower. And on bear setups like double bottoms, you have two valleys. Head and shoulders, two valleys. And that's right, falling wedge, multiple little valleys until price breaks out, with price going higher. On a typical Elliott wave, you would have two peaks. On an ABCD pattern, bullish trade going up, you'd have two valleys. On a bearish Elliott wave, counter trend trade, ABC pattern, you have two peaks. So most of the time, you'll see divergence at these points or here. This bottom line, you have the histogram going lower as price goes higher. On this higher MACD divergence, you have the exponential lines overlapping the histogram divergence. Here you have a high on the histogram with a lower high. Here you have a high on price with a higher high. Take off the lower study, zoom in. Let's look at what pattern this is making. High, higher high, lower high, giving us a nice head and shoulders. Remember, we have to have a minimum of two highs to make higher highs. And we see that all the time where price comes up, gives us a momentum change at this reversal pattern of the head and shoulders. And we know the head and shoulders pattern is based off a range box, so we can duplicate that down for a great target location. Okay, we get an up divergence and a down divergence. Remember what one of our other patterns was? A wedge formation. And the divergence creates that lower support level of that wedge formation. Here we are again with a wedge formation. Divergence pointing that out because the wedge formation has multiple highs before falling off. Great place to take targets at the support of the wedge. And we see price did just that. Elliott wave 1, leg 2, leg 3, leg 4, leg 5. Next, ABC pattern. A leg, B leg, C leg, giving us two valleys which created the divergence for the perfect signal setup. Enter into the trade, take your profits at the highs. Downtrend, double bottom, two valleys, then price runs, maybe head and shoulders pattern, another divergence, then price runs, back to the Elliott wave, leg 1, into a flag pattern, giving you a divergence, take the flagpole, duplicate it up for your target, giving you two valleys for this entry point. I mean, we can all see it. Wedge formation, perfect place to enter into the trade as price reverses higher. Triple bottom, giving you three valleys, or maybe a broadening pattern, right here, giving you a double top, right here, giving you another wedge formation, broadening pattern, showing you the divergence, double bottom, showing you the divergence, wedge formation, and again, and the broadening formation, giving you great entry points. And that's why I like the divergence, because it locates all the reversal patterns for me. Take a trade lower or take the trade higher.